Hello everyone, this is Talisha. Welcome to Gazette discussion for the featured news. So in this particular section, we'll be covering the featured news of 6 July 2021 regarding the G20 and OECD Inclusive Framework. So it was a framework on BEPS, that is base erosion and profit shifting. So let's begin the discussion regarding the featured news. So in this featured news, what is the background of the news? Why this particular event was in news? That is because India has recently joined the G20 OECD Inclusive Framework. Fine. So that is known as IF. So India has joined this inclusive framework, which is actually planning to reform the international tax rules. It has been a century-old international tax regime, which is now getting reformed, and India has joined that development. So India recently joined the G20 OECD IF, that is inclusive framework on base erosion profit shifting. So before we get on to the news, let us see what is base erosion and profit shifting. So if you want to understand this particular concept, let us see this particular example. Suppose there is a particular company this is a parent company in a country, say for example United States, and of this parent company we have an outlet in India. Fine, there is an outlet of this parent company in India, and this parent company this outlet in India has, say for example, earned a profit of 100 crores. Say for example has earned a profit of 100 crores. So with this 100 crores of profit earned by this outlet in India, we have seen that it has to pay the corporate tax now. Fine. So corporate tax for foreign companies in India is close to 40%. Now it has to pay 40%. That means 40 crore rupees have to be paid as corporate tax. But what this company does is that it gets on to this, there is a shell company in place in some tax haven, say for example Bahamas and Cayman Islands, and they actually audit, when the reports are being returned, the returns are filed, they actually file that we have taken some loan from the shell company, or we have taken some patent in technology from the shell company. Therefore, a majority of what we have earned, that is 100 crore, has to be paid to this company. Fine. So on books, it is written that the majority of the profits we have earned here has to be paid to this particular shell company from which we have taken some loan or taken some patent technology or anything like that. So say for example, out of this 100 crores, 90 crores is being shifted to this particular shell company in some tax haven in Bahamas or Cayman Islands, wherein the corporate tax is close to 0%. Fine. So 0% or very low taxation regimes are there in the tax haven countries. Now you're clearly seeing that the profits which the outlet has earned in India are clearly being eroded and the profits are being shifted. Now the base that was 100 crore has been eroded and the profit is being shifted to a particular shell company in a tax haven. Now this is known as base erosion and profit shifting by these companies. Now let us see what the news was about. Now, India and majority of the members of OECD G20 countries have actually joined this inclusive framework on base erosion and profit shifting. Now, these countries, combined these countries, there are more than 130, a total of 130 countries. They have adopted a high-level statement. They have adopted a high-level statement for what? For addressing the tax challenges. Now, why are these tax challenges in place? Because of the digitalization of the economy. We have seen that because of the digitalization of the economy, there are tax challenges for these countries in place, because countries are now, because of the digitalization, the companies are shifting their money, are shifting their profits, are eroding their base. Because of those reasons, it has created a lot of tax challenges for the authorities, and now the countries have come together to adopt a high-level statement addressing these tax challenges because of the digitalization of the economy. Now, OECD G20 Inclusive Framework has agreed on two important principles. Now, these important principles will address these tax challenges. We'll be covering these two pillars after a period of time. Now, we have just seen a statement regarding these particular two pillars, but we have not seen the detailed implementation of the plan. Now, the detailed implementation of the plan will only be finalized by October 2021. So it is yet to be finalized. It will be finalized and the remaining issues will be discussed by 2021 October. Okay, so a total of 130 countries have agreed to overhaul the global tax norms, which are almost a century old. Now we want to overhaul the global tax norms, and 130 countries have agreed to it. To ensure what? To ensure multinational companies, multinational enterprises pay taxes, because they are eroding the base, they are shifting the profits. Now we want them to pay taxes, and there's a pillar number 2 in which a minimum corporate tax has been in place of 15%. Fine. Now they are planning on having a 15% of minimum corporate tax, which the companies will have to pay regardless of where they are headquartered. Fine. So that is your news. And what is G20 OECD Inclusive Framework? This is a framework by 139 countries and jurisdictions. Why was the framework in place? Because these countries are collaborating to put an end to tax avoidance strategies. These companies, multinational enterprises, they actually exploit the gaps and mismatches in the taxation rules, and because of these gaps in the taxation, loopholes in these tax rules, they actually use those rules, use those gaps and mismatches and loopholes to avoid paying taxes. Now, for putting an end to this tax avoidance strategies by these companies, this framework was in place. Now, BEPS package, that is base erosion profit shifting package, provides 15 actions. Now it provides 15 actions, and these 15 actions will give domestic countries and international instruments, give these governments domestic and international tools and instruments to tackle these tax avoidance strategies. Okay, so what is base erosion profit shifting? I already gave you the example of that. It refers to tax planning strategies that exploit gaps and mismatches in the tax rules, okay, by artificially shifting the profits to some distant location in which the corporate taxes are zero or little. Fine. Now, tax challenges. What are the tax challenges because of the digitalization of the economy? There are 3 important tax challenges you need to know. There are 3 important tax challenges because of the digitalization. So these digitalization of the economy has facilitated these important challenges. Number 1, scale without mass. Now, a company which is located or headquartered in the Ireland, that company operating from there will have a large-scale business running in India without any physical presence. Now, that is scale without mass. The company is not present here physically, or the present has a meager, the company has a meager presence in India, but it is operating from outside and it has a huge scale and is operating on the large scale in India. That is scale without mass. Then there is reliance on intangible assets. Now, because of the digitalization, you are clearly seeing a shift towards tangibility to intangible assets, where the countries without any tangible presence, without any physical presence, are relying on the intangible assets and are creating intangible values in the economy and are selling those products and concepts in world over. Now, this is reliance on intangible assets because of the digitalization. Now, there is centrality of data. Now, because of digitalization, because of scale without mass, because of reliance on intangible assets, there is centrality of data. That is, data is being gathered and it has a central server, it has a central location where the company which is collecting the data can manipulate the data, as we have seen in regards to Facebook and Twitter, now as well as WhatsApp. Now, these challenges, digitalization, these features actually pose a huge and serious challenge to the foundations of the global tax system. Now, these are the important challenges. Now, we have to also see, what are the 2-pillar solutions? What are the 2-pillar solutions to address these tax challenges? Now, the first pillar, in the first pillar, we have seen that companies operating from somewhere else, headquartered at Ireland, headquartered at Bahamas, headquartered at, say, for example, Cayman Islands, because there is no corporation tax there, or there is less corporation tax there, because from these countries, what these companies do, They operate from these countries, but their market is in India, their market is in China, their market is somewhere else. Fine, they are running the business, they have a sizable presence, they are participating in the economic activity from at some market else in India or in China, in Pakistan, in these South Asian economies or somewhere else. Fine. Now the jurisdiction, their market jurisdiction is in India, but they are headquartered in Ireland, they are headquartered in Bahamas. Now, because of these reasons, we have seen that no, the countries do not have the tax rights. Why? Because the company is located somewhere else. Now, the first pillar strategy is to give the taxation rights to the country, to the jurisdiction where the company has a market jurisdiction, where there is a market jurisdiction, where the company is running, where the company is actually having a market share, where the company is participating in the business activity, whether it be remotely directed, whether it be directly into that market, but the company has a sizable market share. Now, in that particular scenario where the company has a market share, we would want that jurisdiction, we would want that country to have the taxation rights. Now, it will give and expand the taxing rights of market jurisdictions. That is the first important pillar. It will improve the taxation norms. Now, we also have to know pillar number 2. The pillar number 2 is whether or not the company is located in India or not, whether it be located in a tax haven country, we would actually want that they pay a minimum corporate tax. Now, the minimum corporate tax has to be paid regardless of where they are headquartered, where their jurisdiction is, where they operate, where their market jurisdiction is. We would not say, we don't care about any of that, but we want the companies to pay a minimum of, say, for example, 15% of corporate tax regardless of where they are headquartered. Now, this will ensure a minimum taxation while also ensuring, avoiding the double taxation system. It will also give a level playing field and ensure transparency in the global taxation system, and it will also minimize administrative and compliance costs. Okay, now this is the pillar number 2. Now, what are the potential impacts of the pillars? Now, the first important effect of these important proposals is increase in the tax revenue. Because of these pillars, because of these steps that are being taken, it will increase the tax revenue by $50 to $80 billion per year. It will increase the global corporate tax income. That is, global corporate income tax will be increased. CIT will be increased by 50 to 80% per year, and the exact gains could differ. We are not giving an estimate that this is what is going to happen, that $80 billion will be increased in revenue, but it will depend on how the implementation is being done, how the what is the reaction of these multinational enterprises, what is the government's implementation process, what are the future economic developments. It will depend on those factors as well, but as of now it is being estimated approximately 50 to 80% per year will be the gain by these new taxation norms. Now, taxing, again, there is an important potential impact of the taxing rights. Now, the taxing rights are allocated to the market jurisdiction, as it will increase the revenue. It will increase the revenue. These taxing rights will increase the revenue by $100 billion, and these dollars will be, this much amount of money will be reallocated to market jurisdictions. Now, $100 billion of profit could be reallocated to market jurisdictions. Fine. So that will have an important impact on the economy of that country. It will have a massive impact on that country. Now, there is again a very important positive impact, that is a level playing field. Now, a global minimum tax, say for example of 15%, will give a level playing field and will ensure that countries like India that offer a massive market to these multinational enterprises do not go without having a profit, without having a tax share. Fine. So without providing a tax safe harbor, India is not providing a tax safe harbor to these companies. Without providing that, India can still have a market, still have a taxation share with this particular level playing field of a global minimum corporate tax. Now, effect of proposal on investment. What is the effect of proposal on investment? Okay. Now, we have to understand that this particular step that is a global minimum alternate tax and taxing rights to the market jurisdiction. These two steps will actually enhance the efficiency of global capital allocation. That means it will increase the importance of non-tax factors. Now, if a country is investing in Bahamas, if a company is investing in, say for example, Cayman Islands, we all know why is it investing there, because there are favorable taxation regime. There's a favorable taxation regime. It's a tax haven country, so it gives importance to taxation factors. Now, giving a level playing field, having a minimum corporate tax, it will actually shift the focus from taxation to non-tax factors like infrastructure, like education, like labor costs. Now companies would want to set up their outlets in the countries, set up their headquarters in the countries where there are low labor costs, where there is high education, there is high formal skill in the population, there is infrastructure in the country. Now that is the non-tax factors being given much importance with regard to the this investment. Okay, now low negative impact also, this is again an investment impact. Now with these proposals, we know that these companies will have to pay the corporate tax. It will increase their costs, fine. Now the multinational enterprises will have to pay their costs, their investment costs will increase by a small increase. Why? Because the proposals of this taxation system will actually affect mostly the highly profitable multinational enterprises whose investment is less sensitive to taxes. They're not bothered much about these taxation reports because they are highly profitable multinational corporations, and those multinational enterprises will be affected mostly, fine. So because they are not much sensitive to the taxation systems, so it will not have that much negative impact on the investment. Now investment, no doubt the investment costs will increase of the companies, but it will have an overall positive effect on the total overall investment globally. Now what can be the possible challenges to the framework? What are the challenges? Number one important challenge is the exemption debate. The exemption debate is, even before the framework is actually comes into being, there are already talks about and consensus is being formed about giving exemptions to particular activities. Say for example, United Kingdom and China are seeking exemptions for research and development companies, for airlines and shipping companies. Now they are seeking exemptions for these particular sectors, fine. Now these exemptions, if they are given or if they are not given, this will define the shape that the final global tax negotiations will undertake, fine. This debate will define the shape that what is going to be the future of global taxation systems. Now consensus on the global tax rate. Now there is again an important debate regarding it, because we have actually set up a minimum corporate tax of 15%, which is actually below what was given by United Nations Financial Accountability, Transparency, Integrity Panel, that is FACTI panel. FACTI panel gave a 20 to 30% global corporate tax. It actually recommended we should have a 20 to 30% global corporate tax, and if we had a 25% global corporate tax, it would give $17 billion more to the world's 38 poorest countries, fine. So it would give $17 billion more as taxation money to 38 the poorest countries in the world, in comparison to the 15% rate. So if you only have a 25% rate, it will give $17 billion more. But if we have only 15% in rate, so that is another debate. What should be the rate of the global corporate tax? Fine. Now the global corporate tax, you also have to understand that there is again one more challenge for this particular concept, that is the resistance from these multinational corporations, whether it be Google, whether it be big digital companies like Amazon. They will have to pay more taxes, and they are going to create some resistance because of these important developments. Now you also have to understand, this is a global tax deal. Now this global tax deal, let me give you this zoomed in picture of this. This is a global tax deal. Now you need to know that I have already told you 130 countries and jurisdictions join OECD and G20 tax agreement. There is a two-pillar strategy, that is giving local taxation rights and corporate tax floor of 15%. Now what is going to be the impact of this particular deal on the India's equalization levy? Now you need to know that India had in place an equalization levy. Let me show you here. So we had an equalization levy in place. Okay, so here is this equalization levy. Now India actually, in the finance bill of 2021, India actually gave a 2% DST. Now what is a 2% DST? It is a digital service tax. It was actually given implemented on the e-commerce giants, which are actually the non-resident e-commerce companies, and they are earning profit in India. India actually implemented a 2% equalization levy or digital service tax on these particular companies, which was heavily criticized by United States Trade Representative USTR, and it actually said that this is very unreasonable and discriminatory on part of India to have this equalization levy on our companies. Why? Because United States, that is 75% of the companies on which this equalization levy was levied, they were 75% from America. That is 75% of the companies were American companies on which the DST was imposed. Now this DST having been implemented would have increased the tax bill by more than 30 million US dollars. Fine. Now this will have the two-pillar strategy of this particular global tax deal will have an impact on this equalization levy. As equalization levy was imposed by India, will have to be rolled back. It will now have to be rolled back because we have in place now a minimum global corporate tax. India will need to evaluate tax under new regime against equalization collections, and finance minister has called for meaningful and sustainable revenue to local market. Now this is an important concept regarding this equalization levy and these two-pillar strategies. Now what is going to be the conclusion? This tax deal seeks to address the concerns of both the developed as well as the developing countries, because we have seen that G7 and these developing countries, G7 and European Union, may gain more than 2/3 of the new revenues that will be created by this global minimum corporate tax of 15%. It will gain more than 2/3 of that revenue will go to G7 and EU countries, and less than 3% will go to world's poorest countries. Now you are seeing, no doubt it is not equally distributed, but still it will address the challenges and concerns of both the developed and the developing countries regarding this corporate taxes. And there is also a conflict in this particular scenario between the countries that are that want the taxing rights, and between the multinational corporations that want the certainty of taxes, that want no tax litigations, that want ease of doing business. Now this is a conflict. On the one hand, there are governments governments that are looking for taxation rights, and on the other hand, there are multinational corporations that want certainty of taxes, that want taxation that do not want tax litigations. Now this is a conflict, and we need to see a consensus being emerged between these two ends, and that is going to be very interesting to look at in the future developments. So this is it regarding the featured news. I hope you enjoyed the session. Please subscribe to the channel and like the video and share the video and press the bell icon. God bless you. Bye-bye.